So today we're going to talk about how you as a beginner investor should approach the stock market. And to do that, I am going to share with you some key principles that Peter Lynch and Warren Buffett used for their approach to investing. So let's just dive into 6 key principles used by Warren Buffett and Peter Lynch when they are looking to make an investment. So the very first principle that both Warren Buffett and Peter Lynch agree on: buy stocks you understand. If you're a tech person, buy stocks in the tech field, buy stocks that you understand exactly what that company is doing, what they're about, and what products they're making, all right? If your only reason for owning a stock is because it's worth a lot, that is not a good reason. You need to know why you own that stock. If you can't explain why you own a stock, then you should just not own it, plain and simple, all right? So if you are somebody who's big on the tech industry, don't go buying stocks in, beauty industry if you have no idea what the beauty industry is doing or where it's going or any sort of historical trends in that area, unless you've done your homework, of course, and you know a lot more by research. So only buy stocks you understand. If your only reason for owning them is that it's just worth a lot, you should not own it. Number 2, something you need to be aware of. You only sell stocks when there is a major shift in the operation of that company. So for example here, let's say you buy Home Depot stocks, but a couple years from now, they say we're no longer selling lumber or do-it-yourself tools or anything like that. We're just strictly going to go to a wholesale appliance store. Well, they sell some appliances now, but that's not their major function. So they've had a major shift. At that point, you have every right to sell that stock because Home Depot is not what you bought into, right? Same thing with Amazon. If Amazon was all of a sudden to come out tomorrow and say, hey guys, look, we're going to step back here and we're actually just going to be a makeup line. Like, what? That's not what you signed up for. So you have every right to sell stocks that are no longer what you bought them for. And the third thing, please don't do this. Don't buy stocks because of somebody else's opinion. You need to do your own homework, your own research. I don't care if they're super credible. I don't care if they've been doing this a very long time. You need to know why, again, going back to number 1, you own that stock, and it needs to be something you can understand. So don't buy it unless you've done your homework. Number 4, a lot of people will try to predict the market and say, well, this is coming, we're due for a bear market, blah, blah, blah. Guess what? You need to go off fact and not some prediction. Fact, there will be times when the market goes up, and fact, there will be times when the market goes down. That's just the nature of the beast. So be prepared. Number 5, opportunities come when times are tough, okay? If you've been doing your homework, if you've been doing your research, and you know about some of these stocks that are now maybe available at a much better price than what you were originally looking at them for, that's the time to snatch them up. Seize that opportunity. And because you've done all of your research, you understand that buying now in a downturn, you're actually getting a bargain that's going to pay you dividends in the future. And number 6, utilize your existing knowledge to take full advantage of the market. So what does that mean for you? Well, if you're a phone guy and you work in the phone industry, you sell phones, you're around people who are buying phones day in and day out, that's just your niche, then you, my friend, have an advantage. When you see something like Apple release the very first iPhone, that should have been an indicator. You need to pounce on that because you see the opportunity. It's something in your market that you have a full grasp on and understanding of what that's going to do to change the phone industry. So things like that. This goes to automotive industry, steel industry, real estate. I mean, it's a little different when we're talking stocks. But the point is, every industry has clear indicators when something is happening based on how the market is responding. And you need to respond quickly. So take full advantage of your existing knowledge in your industry to capitalize on that and buy stocks where appropriate. Okay, so keeping all of that in mind, let's cover 5 questions you need to ask yourself before you start investing. The very first question you need to ask yourself and have an answer for: do I want to do all of the investing myself, or do I want to have somebody manage it for me? Number 2, are you opening a retirement account? So we're going to save for retirement. Or is this a taxable brokerage account where you're just investing and trying to gain some capital because you've already been saving and you're already putting away for retirement? Number 3, do you know the difference between stocks and stock mutual funds and exchange traded funds, or ETFs, as some of you may have heard? There is a difference. With a stock, you're buying a share or multiple shares, and they come at a much higher price tag because you have to buy the entire share, whatever it is worth at that time. Whereas with a mutual fund or an ETF, you're buying little pieces of the share that are lumped together in this smaller portfolio. So maybe you're only buying a 16th of that share, but you're getting a 16th of multiple shares versus just one share over here. And the 4th question you need to ask yourself, how much do I have to invest right now? Kind of a big deal because that's also going to determine how you can invest. When you have more money, you have more options. When you have a little less available, then maybe you're going to be capped out on certain things because maybe you can't afford a $2,000 Amazon share. And number 5, are you comfortable keeping your money in the market for at least 5 years? Why is that? Because the stock market is a long-term strategy, okay? It's not a get rich quick, not typically. Very few and far between actually find success that way, okay? So if day trading is your thing, this is not the place for you. But if you have a long-term strategy and you want to be invested over time, ask yourself, can I spend at least 5 years in the market? And I also say that for historical reasons. So when you look at the stock market between 1926 and 2017, for example, we find that there have been 8 bear markets that have lasted 6 months or more. So knowing that, you need to know you can't just keep your money in the stock market for a year and expect to get a lot of money out of it, because there will be times where the market is down for quite a bit. And I think it was in the 70s where that lasted for like 2.5 years where the stock market was down, and it was pretty significant. So knowing that you want to be a smart and wise investor, you need to have your money in the market for a minimum of 5 years to start to even see some potential gains. So there you have it, 6 principles and 5 questions that you need to ask yourself before you start investing. And we will get into how you go about investing and setting up a brokerage account in the next video. So be on the lookout for that for part 2 of this series. And if you are not already subscribed, please be sure to do so and hit that bell so you know exactly when I post it. And give this video a like to help out with the algorithm. I hope to catch you on the next video.